So a plant asset is just an asset that is, well, here's the definition up on the screen. It's tangible, it's actively used in operations, it's expected to benefit future periods, and we call it property, plant, and equipment. Okay, that's what plant assets are. Typically, it means land, buildings, equipment. Okay, that's usually what we mean when we're talking about plant assets. So not the type of plants that grow in the ground, but like a plant, like a like a facility for a building that belongs to a business. Oops, this thing is laggy. All right, so there's 4 issues as we work with our plant assets. We need to know what it costs us to acquire, or our acquisition cost of the asset, and then how long we're going to use it for. And then finally, we have to account for when we dispose of it. So these are where the accountants come into play, I guess would be a way of putting it with plant assets. When we acquire it, through the use of it, and at the disposal of it. The accountant's not out there using the equipment all day, but at these different points in its life, we're going to have to do entries. So the first thing we need to do is figure out how much an asset costs. Seems easy, right? It seems like you would just say, hey, whatever we paid for it, that's what it costs. But it's not only the purchase price, but a lot of times, like with equipment, you've got to get it shipped to you. Say a big piece of heavy equipment, then you've got to get it, bolted down to the factory floor and ready to use. So really, the acquisition cost is all costs of getting the asset purchased and getting it put into service, ready to use. I own a storage business, and so as I'm constructing a building, I actually create an asset account, and the cost of all the materials for the building, and then the cost of the labor, I just keep adding to that account. And then finally, when I'm ready to put start renting units in that building, I kind of close out that account and open an account called building D, or whichever building I'm building. And so all of those costs, not only all the materials, but the labor, the insurance, all that to get it built, I consider all of that part of the acquisition of the asset. So common things that go into machinery and equipment: the purchase price, the taxes on the purchase price, the transportation, the insurance while in transit, and the installation, assembly, and testing. So kind of all the things I just said, but I have a slide for it. Buildings, again, the cost of construction, any brokerage fees, title fees, attorney fees, taxes, we would consider all of those part of the cost of acquiring a building. Here's an important thing. We record land as an asset, but we'll record land improvements as an asset that is separate from the land. So anything like parking lots, driveways, curbs, lighting systems. The reason that we record these as separate is that we don't depreciate land. Land continues to keep its value, so to speak. But land improvements, they depreciate and will need to be replaced, right? Even parking lots will break down over time and you'll have to put a new parking lot in. So we track our land improvements as separate assets from the land itself. There's all the costs that go into acquiring land, and then land is not, in bold red, not depreciable. Some people, I spend a lot of time telling people depreciation is not about something losing value. It's about spreading its cost over the useful life. So recognize that the reason land is not depreciable is that its useful life is kind of like infinite, right? Like land continues to be useful in theory forever. I suppose there's things we could do to land to make it not useful, but so we don't depreciate land. That's a standard rule. All right, so here's an example. This is what's called a lump sum purchase. It's very common when we purchase land and a building that they get lumped in together. People don't say, I'll sell you the land for $40,000 and the building for $50,000. They just say $90,000 for the land and building. So what we're left having to do is we have to split out the cost of the land and the building because we need to track them as separate assets. So here's our example. CarMax pays $90,000 cash to acquire a group of items consisting of land appraised at $40,000 and a building appraised at $60,000. The $90,000 cost will be allocated on the basis of the appraisals as shown. So you can see that our appraised value was actually $100,000. $40,000 for the building, $60,000. I'm sorry, $40,000 for the land, $60,000 for the building. But we only paid $90,000 in cash. So it makes it difficult to know how to allocate it. And all we do is we figure out the percentage of the appraised value that each item is. So if we spent a total of 100,000, then the building, the land was 40% of that cost, and the building was 60% of that cost. And then we apply that percentage to the amount we actually paid. So we would say, okay, we paid 90,000. Then the land will be what we'll record at 40% of the 90,000, which is $36,000. And the building will record at 60% of the 90,000, which is 54,000. So you might see some problems like that. And again, all you're doing is sort of breaking out the actual price you paid by the apportioned rate of the appraised value of the assets, because that's all you really can do, right? Most businesses would like to call, to name as much as they can building costs, because that's depreciable, meaning you get to take an expense for it over time. But if you try to do too much, the IRS is going to come back and challenge how did you come up with that? So just getting an appraisal value and then splitting up the cost by those percentages is the safest way to show that you used a reasonable, conservative method for allocating those costs. So depreciation, here's your definition: the process of allocating costs of a plant asset to an expense in the accounting periods benefiting from its use. And you're like, I don't know what that means. It broke my brain, maybe. Here's the idea. If I have an asset that I expect to provide value to me over multiple periods of time, then rather than just taking the expense all at once when I purchase the asset, what I should be doing is spreading out that expense over the asset's useful life. If you think about it, if I get a piece of equipment and I make $1 million using that equipment to make product that I'm going to sell, if I were to, and let's say I pay $500,000 for the equipment, if I were to take that all as an expense up front, then in that first year I'd have like $500,000 in expense and zero revenue related to that asset equipment. Then the next year I'd have, let's say it's a 10-year asset, so I'd have $100,000 in revenue and no expense, and that would occur for the next 10 years. And it just sort of violates the basic matching principle that accounting is based on. So instead, what we're going to do is say, hey, if I have that asset, if it's for 10 years and it costs me $500,000, why don't I split that up? I'll take $50,000 in expense each year. And so then each year I'll have the revenue of $100,000 I made from the equipment minus the expense of $50,000 that I found from the depreciation. And that shows me truly how much money I'm making from the asset each year. So when we depreciate, we need to know how much something costs. That's the next slide. So we'll need to know how much something costs. We'll need to know the salvage value. That's how much will the asset be worth at the end of its useful life. And then we need to know its useful life. In other words, sometimes, like say you're a rental car company, you might buy a car for $40,000, but know that you're going to sell it after 3 years and still be able to sell it for $18,000 or something like that. And so that's what salvage value is. What value can I sell this thing back for at the end of its useful life? And then its useful life, sometimes in years and sometimes in other measures, which we'll go over. So we'll talk about 3 different types of depreciation methods in this course. These are really the most common. Honestly, the straight line, the first one there, is like by far the most common, especially for small businesses, because the IRS just puts out a straight line schedule for most assets. And so if you don't want to try to come up with some, fancy method of depreciating an asset, then you just use the IRS's table. You know it's safe because they've approved it ahead of time. And so most people just use, it's called MACRS, or sometimes people call it the makers. And I think it means, I don't use it enough, modified allocated cost recovery system or something crazy. Like it's, it's the government. So it's a big acronym, or maybe it's adjusted. I think it's allocated. Anyway, so the straight line method, the units of production method, and the declining balance method. So we'll go through 3 examples, all using the same asset. This asset had a cost of $10,000, a salvage value of $1,000. So you'll see that sometimes they'll use this term, our cost minus our salvage value is our depreciable cost, which means the amount of that cost that we're going to depreciate over the asset's useful life. It has a useful life of 5 years, and it also has a useful life of units of 36,000 shoes. Apparently it's a shoe inspecting machine of some sort. So we'll get to what that means in a minute. So here's how we do straight line depreciation. We've actually already done this in this course back when we did adjusting entries. We were introduced to the idea. So to find out how much depreciation we'll do, we take the cost minus the salvage value. Remember, they called that depreciable cost. And then we'll divide that by the useful life in years, or in periods. In this case, it's 5 years. And that tells us that we will depreciate $1,800 per year. And again, when we depreciate, what we're doing is recognizing a portion of the asset's cost as an expense for that year. So depreciation entries always look like this. They're done at the end of the period. They debit depreciation expense, and then they credit an account called accumulated depreciation. And there's usually a separate accumulated depreciation account for each asset that your business owns. So depreciation expense and accumulated depreciation. Here's what a straight line depreciation schedule would look like. Our book value is the cost of the asset minus any depreciation. So when we purchase it, our book value is the same as our cost of acquisition. Then we'll recognize in these next years, there's a depreciable cost. That's the asset cost minus the salvage value. Since it's an asset that has a 5-year useful life, it means we're going to depreciate 20% of that depreciable cost each year, or $1,800. So at the end of the first year, we'll have accumulated depreciation of $1,800, and our book value, which is our cost of $10,000 minus our accumulated depreciation, will be $8,200. And you'll notice each year we'll take the same amount of depreciation expense, and the accumulated depreciation will accumulate. It will add up. It was $1,800 in the first year, then 36, 54, 72, 9,000. At the end of the asset's useful life, our book value should equal our salvage value, because we'll have fully depreciated the depreciable cost of 9,000, leaving only $1,000 left for the book value. Again, remember, book value is just cost minus accumulated depreciation. So this is how straight line depreciation works. It's how the majority of small businesses deal with depreciation for their assets. So if you did go to work as an accountant for a small business, likely you would see something like this. The nice thing about this is once you've calculated, or you know what your depreciation expense is, then the adjusting entry at the end of the year is always exactly the same, right? Because it's a straight line. It's the same amount each time. All right, so the second type, a second depreciation method is something called the units of production method. And the units of production method is a 2-step process. The first step is we have to figure out what our depreciation per unit will be. So we do that by doing the cost minus the salvage value, and then we divide that by the total units of production. What we mean by units of production is that some assets, their useful life is better measured in some unit other than time, right? In the first one, we used years, but maybe a car's useful life is better measured in miles than it is in years, right? You could have a 20-year-old car, but if you only drove it 1,000 miles a year, it would still be going strong. And so units of production you would use when there's an asset. Sometimes, like with farm equipment, they'll measure that in operation hours. Sometimes in production equipment, it'll actually be units of production, how many units the equipment produced. Okay. So once we do cost minus salvage value, divide that by units of production, that gives us our depreciation per unit. Then to calculate our depreciation expense, we just take our depreciation per unit times the number of units that we produced for the period. That's all. So here's our example. We know that the unit has 36,000 shoes inspected in its useful life. And we know that our depreciable cost is $9,000, which is our cost minus our salvage value. So we take 9,000 divided by 36,000, and that tells us we could depreciate 25 cents per unit of production. And then it tells us 7,000 units were inspected during the first year. So we would take the depreciation per unit of 25 cents times 7,000 would give us $1,750 in depreciation expense that first year. The journal entry would look the exact same. I don't have it up here, but it would just be a debit to depreciation expense and a credit to accumulated depreciation. So exact same titles as under the other method, under straight line, just that the dollar amounts will be slightly different. If you think about it, by the end of the asset's useful life, we still have to depreciate the same $9,000 in depreciable cost. So these two methods are just different ways of going about doing that. One uses time as the factor for depreciating. The other uses the units of production. So there's our depreciation schedule. You'll see that here they have different number of units each year, but it's the same depreciation per unit. We just multiply the number of units times depreciation per unit. That tells us how much depreciation expense we have in a given year. And then remember, accumulated depreciation is just, any depreciation from previous years plus the depreciation from this year gives us our total accumulated depreciation. And our book value is our cost less our accumulated depreciation. So that's the units of production method. The third one is the most complicated one. They always save the best for last. This is called the declining balance method. So this has 3 steps. So here, the first thing we have to do is we have to calculate our straight line rate. In order to calculate our straight line rate, we just take 100% and divide it by the number of years in the asset's useful life. So the straight line rate for an asset with 5 years in its useful life is 100% divided by 5, which is 20% per year. That just means if we were using straight line depreciation, we would be depreciating 20% of the depreciable cost per year, or 1/5. Then using the declining balance method, we're going to double that rate. So if our straight line rate was 20%, then we're going to double that to 40%. And now to find our depreciation expense, we're going to take our double declining balance rate, which is 40% on this one, and we're going to multiply that by the book value of the asset. So in the first 2 methods, we went by the depreciable cost. But in this method, the declining balance method, we're going to go by the beginning book value of each period, which means as the balance comes down, the amount of depreciation is going to be less and less. So this is sometimes called an accelerated depreciation method because it lets us take a bigger chunk of the depreciation expense up front than in later periods. If you think about it, a lot of expensive assets, think of like a car, we are kind of using up a lot of their value early on, right? You buy a car, you drive it off the lot, you're never going to get what you paid for it. The idea is you've already used a big chunk of its value. So this is sort of recognized in the double declining balance method by letting us take a bigger piece of our depreciation up front and then declining amounts going forward. So here's what it would look like. So our beginning book value was $10,000. That was our cost. We multiply that by 40%. So our depreciation expense for that year will be $4,000. Our accumulated depreciation will be 4,000 because we didn't have any before. And our book value will be our cost minus our accumulated depreciation, or 6,000. Going into the second year, we'll have $6,000 beginning book value. We'll multiply that by 40%. That will give us 2,400 as the depreciation expense for that year. We'll add last year's accumulated depreciation to this year's depreciation expense to give us this year's accumulated depreciation of 6,400. And we'll follow that same process. The thing that's different about this one is in the last year, we won't do any calculation other than to say, here's my beginning book value. And I know that I have a salvage value of 1,000 I need to add to end up with. So I will just take enough depreciation expense that last year to fully depreciate the depreciable cost. So if the beginning book value was 1,296 and the ending book value needs to be 1,000, then I'll take 296 as my depreciation expense for that year. And that sometimes throws people off because they've been multiplying this out each time, and then they do it on the last one and it doesn't work. All right, so that's the three methods. I don't think one of them is superior to the other. I think it depends on the needs of the business. I think straight line might be superior in the sense that it's easier, but not necessarily in the sense that it's more accurate. Fernando, you have a question?
Yes, sir. Sorry to interrupt. So is it always just 100% divided by whatever the year is? So let's say if it's 6 years, so it's 100% divided by 6 will give us our percentage?
Yep. It's always 100% divided by the number of years in the asset's useful life to find the straight line rate.
Thank you.
All right. In the real world, we don't always buy every asset on January 1st and then sell it on December 31st, right? That'd be nice, but we often have partial years. So when we purchase something during or, in the middle of a year, then what we're going to do is we're just going to calculate the depreciation on the fraction of the year the asset is owned. And typically I see this done on a monthly basis, not a daily basis. What I mean by that is if you buy it on the 15th of the month, you typically just say, we're just going to count that month as the purchase month. We'll see if this book gets more specific, but here's the example they give us. It was purchased on October 1st. So we would still calculate out what our straight line amount would be for that first year, but then we would multiply that by 3/12, because if you bought it October 1st, you have October, November, December, 3 months during that first year that you're depreciating for. So if you buy an asset in the middle of the year, then you're only going to do a partial depreciation, the number of months you've owned it. Recognize that things like salvage value and useful life are estimates, right? Like we don't know for sure what we're going to be able to sell the asset for at the end of its useful life. We don't know for sure if an asset's only going to last 5 years, or if it might last 6, or it might break at 4. So these are just estimates. And so sometimes new information can come to life in the middle of it, and you may have to adjust your estimates from there. This is something I mentioned before when I was talking about that other assignment. What was it called? The ethics assignment. Is that usually with equipment, we're going to have to continue to spend money on it, right? If you own a building, anybody who owns a house knows this. It's, you think I'm not renting, but you have to pay for just the upkeep of a house. So we break down the additional expenditures into either what's called revenue expenditures. Those are expenditures that don't increase the asset's life, and we record those as an expense in the current time period, and we report them on the income statement as an expense. As opposed to capital expenditures, those are ones that extend the life or substantially change the asset. And so those will be recorded as an addition to the asset account and reported on the balance sheet. So they give a couple of examples here. Ordinary repairs, those are revenue. Maintenance, also revenue. So the most common type of like capital expenditures I'll see is like when they, when they add a new wing onto a building or something, or they, I don't know, they putting a new engine in a car. That is not a normal just maintenance thing. That is actually extending the life of the car. And so we would capitalize or roll the cost of that engine into the cost of the car, and then recalculate our depreciation based on the new estimated life of the vehicle. Well, so ordinary repairs will look like this. We will debit repairs expense, or sometimes maintenance expense if it's a maintenance, and we'll credit cash. Whereas improvements or capitalized expenditures, we'll actually debit the asset account and credit cash. All right, so what do we do when we sell our plant assets? So in order to, this says disposal. So sometimes we honestly do just throw an asset away, right? It's just not worth anything anymore, so we get rid of it. Other times we sell it. So we have to go through this process. The first thing we have to do is update depreciation to the date of disposal, because typically we only enter depreciation entries once per year at the end of the year. So if we sell the asset in the middle of the year, we need to record any depreciation expense from the beginning of the year up to that point where we're disposing of the asset. So that's the step one. Then we have to journalize the disposal by recording any cash we receive, which would be a debit to cash, or any cash we have to pay. It always stinks when you're getting rid of an asset and you have to pay someone else to get rid of it, right? You have to pay them to haul it off or something. Recording any gain or loss. We have to remove the accumulated depreciation account, and we have to remove the asset cost account. So that's, and I'll give you an example here in a minute, but that's the process by which we record the disposal of a plant asset. So here's how we discard a plant asset that's fully depreciated, meaning we're not getting any money for it, and it's our accumulated depreciation account is the same as our asset account. So it's fully depreciated. This one has zero salvage value. So to do that, all we're going to do is debit the accumulated depreciation account, which will make that account now have a balance of zero. And we'll credit the asset account, machinery in this case, which will make that account have a balance of zero, and we're done. The asset's off our books. We're good. We didn't make a gain or a loss on it. We didn't pay any cash or receive any cash. So that's a fully depreciated asset. Here's what we do if an asset is not fully depreciated. So here we have equipment with a cost of 8,000 and accumulated depreciation of 6,000. And we're using a straight line depreciation over 8 years with zero salvage value. So the first thing we have to do is record our depreciation expense up to the day of discarding it. So it's July 1st. So how do we do that? Well, we go, let's see, there's an 8-year asset that costs $8,000 with no salvage value. So that means the depreciation rate straight line would have been 1,000 a year. And then since we're doing 6 months here, we'll do 6/12 of 1,000, which is $500. So our first entry will be to record depreciation expense of 500 and accumulated depreciation of 500. That brings our depreciation current to the date of disposal. Then we're going to record, we're going to debit the accumulated depreciation account's total value. That will get accumulated depreciation off our books. We will credit the equipment account for the full value. And then any difference between the two will either be a loss or a gain. So I always do my accumulated depreciation debit and my asset credit, and then I look for the difference. And if it's on the debit side, remember expenses get recorded on the debit side, that's going to be a loss. If the difference happens to be on the credit side, then that's going to be a gain. Fernando, yes.
How did you come up with $500? Is that, I kind of missed that.
Sure. So the equipment costs $8,000 and it has a useful life of 8 years and 0 salvage value. So I took 8,000 divided by 8, that's $1,000 a year depreciation expense. And then this asset we're discarding on July 1st. So I did January, February, March, April, May, June, 6 months worth of depreciation. So I took 1,000, which was a year's worth, times 6/12, and that gave me 500. That help? I see nodding. I'll take that as like maybe, but I'll have to work with it a little.
Yeah, clear as mud. Yeah.
Okay, sorry.
It's all good. It'll come to me at the last minute. So.
Yeah, so all we're doing when we do that is we're figuring out what the annual depreciation is and then multiplying that by whatever fraction of the year we've possessed the asset up to the point when we're selling it or discarding it. Like anything else, it comes a little easier as you do more of it. Whoops. Here's what it looks like when we sell a plant asset at book value. So here they sell equipment that originally cost $16,000 and has accumulated depreciation of $12,000 at the end of the last year. And we're selling it in March. We use straight line depreciation at $4,000 per year, and we sell the equipment for $3,000 in cash. So again, first thing we have to do is bring our depreciation expense up to date as of March 31st. This one tells us it's $4,000 per year. And so we're selling it at the end of March. So 4,000 times 3/12 comes out to be $1,000. So we depreciation expense and do accumulated depreciation. And then again, so just remember, there's always this same process as we, so we're going to record the cash we received. It says we sold it for $3,000 cash. That's an increase to our cash, so it's a debit. And then we have to record the full amount of the accumulated depreciation account, because what we're doing is taking that account down to 0. So it will always have a credit balance. So we'll debit that account 13,000, so the new balance will be 0. And then we're also going to record the full amount of the asset account, equipment in this case. It will always have a debit balance, right? That was our original cost. And so again, here you can see we have a credit to the equipment, so the equipment account is going to go to 0, a debit to accumulated depreciation, so that's going to go to 0, and then the $3,000 cash we received, and there's no gain or loss because we sold it for exactly what its book value was. Here's where we sell an asset for above book value. Again, bring our depreciation up to date. We record the cash we received. We debit the accumulated depreciation amount. We credit the equipment account. And again, what I always do is I do these 3 entries first, and then this amount is just what I have to do to balance it. So I have 20,000 on the debit side, and I have 16,000 on the credit side. So I'm going to have to credit this account $4,000. If it's a credit, it means it's a gain. It means I made money, or I sold it for more than my book value. If it's a debit, then it's a loss, meaning I sold it for less than the book value. So that's my process, is record the cash, which is always a debit if you're receiving money. Debit the accumulated depreciation account, its full balance. Credit the equipment account, its full balance, and then the difference will be the gain or the loss. Here's selling a plant asset at below book value. Again, step 1, bring our depreciation up to date, record the cash, debit the full accumulated depreciation account, credit the full asset account, and the difference, in this case, a debit of 500, will be our loss. So the process, it may seem a little intimidating at first, but after you do a few of them, it'll start to click. I mean, that's